we've got the pandemic that's clearly in the driver's seat still. It's not in the rearview mirror like I'm showing. This is something that we're going to have to deal with, I think, for some time period yet. And it's impacting prices, more volatility than I've ever seen in my career. And it's impacting this year because of some changes we've had, the PPDs in our milk checks. So I'll try to give you an idea about what I think 2021 will offer. You know, the pandemic, it's not over yet. We've had 40 million cases worldwide, more than 1 million deaths. United States, 8 million cases, 220,000 deaths. And here in Wisconsin, we are a hot spot. We're increasing rapidly, and even though our case testing is accelerating very rapidly, the percent positive tests coming through is extraordinarily high. So we're not done with the pandemic. We still are going to have many months of this, I think, ahead of us, and it's going to be impacting our dairy markets. When you take a look at what's been happening in the U.S. over time period, this gives you an idea that we're kind of headed into our third surge. You know, the initial one was happening around March and April, and that's when we had a lot of the impact on dairy markets with our safer at home, closing down restaurants, schools, and so forth, prices with incredible volatility. But we began to bring that down on through the summer. And as we relaxed and began to open up the economy again a bit more, we saw a second surge with peaks in middle part of July. Getting on top of those were some of the states like Alabama and Texas began to, and Florida, improve the positive COVID IDs that they had. We retrenched again, but now we're surging one more time. And I don't know how many times we're going to see that kind of pattern showing up. We're clearly not at the peak of this third resurgence and more cases all the time. So pandemic is continuing to provide us problems. The markets have changed tremendously. And one of the changes that we saw back in April and May was this shift when we became safer at home. From out-of-home eating to buying dairy products and other food items in the grocery store and preparing foods at home again. This is a restaurant performance index, and it's just showing you what restaurants have responded to, not specifically for COVID, but they've done this for many, many years. They've had this index. It's comprised of the number of meals they're serving, you know, whether people are buying higher up on the end of the menu or at the lower end of the menu, what kind of investment restaurants have been making in their capital and infrastructure. And if it's above 100, it's supposed to be expansionary for restaurants. They're growing. If it's below 100, it's contractionary. And you can see for sure that we're down in this contractionary area. You can't read into this and say something like, well, I guess it's down to 95% of normal. That's not what this really means. It means that restaurants are seeing a much worse time than they did in the previous recession we had in 2008 and 9. So it's been a really tough time for restaurants, and market channels have had to adapt to where consumers are and what the demand has been. They've been doing it though. Historically, about half of our cheese is consumed in out-of-home eating. The vast majority of American processed cheese, that's the barrel cheese that we make, goes into things like those little square yellow slices that we get served on a McDonald's hamburger to make it a cheeseburger. Or it gets pumped onto a plate of nachos, you know, for that kind of product. And that's almost exclusively, not quite exclusively, but almost exclusively food service items. So product moved in those plants very quickly as that demand collapsed, and we tried to find new homes for milk going into that kind of plants. Oddly enough, pizza sales have surged. They're takeout or home delivery anyway, And that's been a real bright spot for the dairy industry through this. And honestly, we've had this farm to family food box that's created a different kind of demand. Some of that was demand that might have been met through restaurant service before this happened, or it might have been met through retail service. But nevertheless, a lot of cheese was bought for these products or the food boxes, and it's had a big impact on our prices. Total cheese consumption, if you look at everything, has been up at retail and down at food service and institutional places. But if you look at the total here, add it all up, it's down a little bit, about 0.4%, but it was expected to be down much further than that, maybe as much as 5%. That didn't happen, and thank goodness. And by the way, when I said down by 0.4%, that's from April through the present time period. So during the time of COVID, compared to that same period last year. I mentioned that barrel cheese plants really had quite a hit early on. We have 5 barrel cheese plants in our region, Minnesota and Wisconsin, and those plants account for maybe 12% of the total milk production in those 2 states. So we could accommodate that volume in other plants, but it's a lot. And it happened, we moved it around, and the barrel plants are back and processing product again now, finding sales for it. But we lost a lot of demand early on. Even fluid milk, my gosh, you know, this chart that I've got on here is showing you the trend in per capita, not per capita, total fluid milk sales over time. In about 2010, it began to take a nosedive. We're all familiar with that. And you have to kind of look down here in this bottom right-hand corner to see where we've been since COVID. As people have stayed home, they've gone back to buying milk, and most of that milk is consumed in the home prior to pandemic, and sales are up. It's reversed a long-standing trend. Hardly back to where we were, you know, in 2010, but it's taking a nice direction now anyway. There were reports of empty shelves in retail stores early on, but those were short-lived. They've managed to reconfigure and get product onto those store shelves. Some of that came from changing the packages and shortening the number of stock keeping units in stores. If you go in there and look, in many retail stores to this day, you are going to still find that you don't have all of the options that you had for buying dairy products early on. When plants couldn't keep up with retail demand, the retail stores just told folks, look, just give me the gallons and half gallons in whole milk and 2%. Because, you know, we aren't selling quarts of skim milk or 1%, those kind of things. We can live without that stuff. Give us the high volume products. So they've done that. And frankly, if you look through the entire retail store, you will probably find nowadays that the SKUs are down for lots of products. You don't have 20 different packages of flour available to you, you know, different vendors and different package sizes and different types of flour. You're trying to see mostly that we've got the items that move big volumes. Butter is a different product. Markets are moving to meet that demand. More than half of the butter has been used in out-of-home eating. It's really featured in high-end food service, restaurants, and institutional uses. It's been substantial. But since we've been home alone and cooking at home, pandemic cooking is a real thing. Butter sales have been way up at retail. We've been moving a lot of product, and total commercial butter disappearance is up 7%. So even though you've lost a lot of that usage in restaurant and out-of-home eating, it's been more than made up for in in-home eating. So it's going to be interesting to see how, when we get past this pandemic, you know, the retail sales hold up. But I've got concerns about the marketplace. We had base excess plans that were implemented by cooperatives, and we had some direct ship producers who were told by their plants to just stop or slow down milk production. They couldn't handle what they were taking before. And in this chart, in the red line, you can see where we were pre-pandemic, and you can see what happened in April and May. This is when we got the notice that we had base excess plans implemented. Clear drop off in milk production. Normally, the peak of our seasonal milk production, the flush, happens in May. It didn't. We had a big drop off, and peak was actually in March. But since that time period, better prices that have been seen on farm and in paychecks have caused people to be expanding that. And we've even had plants and co-ops that have said, yeah, bring us the milk, we need it. And farms have been responding. The urge to capture some of these higher milk prices has really officially put us into big increases right now. This is quite an increase in milk production. And actually, I'm wondering if we kind of got our foot caught on the gas pedal a little too hard, but we'll see as time reveals. Those pandemic prices haven't been as bad as a lot of people, including myself, expected. But I'm really not sure how much milk we can handle. The milk powders are clearing the markets, but that's because our exports that originally got shut down when ports were closed overseas opened back up, and we had the opportunity to sell a lot of powder. We've had as much as 3/4 of the powder in this country being sold as exports. They're clearing the marketplace. But butter stocks are growing, and I'll show a little bit more about that later on. And the fat surplus is one thing that is a little bit concerning and going to keep some pressure on prices. As I mentioned, food boxes have moved a lot of product. It's estimated that food boxes may have accounted for somewhere between 4 and 5% of our milk production. So the dairy products that have been included in these giveaways have been significant in the purchases made by the government to distribute food to food insecure families. And that's caused a real tightness in cheddar cheese markets in particular, and really caused some volatility there. Back in April, we had milk price or cheese prices, the spot prices on the Chicago Mercantile Exchange, that dropped to a low of $1 a pound. My gosh, we haven't seen $1 a pound since 2006. And that was a shockingly low price. But at $1 a pound, it was less than the rest of the exporting world was at that time, even in a pandemic, quite a bit less. And in fact, we had a short-term burst of export sales of cheese at those low prices. But pretty quickly, with the food box program getting going and the sales through exports and pretty strong sales even at retail here, all of a sudden we had shortage of cheese. And 6 weeks later, the CME was at $3 a pound. It was incredible. We lost those export sales overnight when we got up to a $3 a pound cheese price again. One of the things I have a concern about is a worldwide recession. We are certainly in recession technically right now, and most of the rest of the world is as well. Not all, but most. And the virus-induced supply chain disruptions, not just for dairy, I think is going to mean that even when the pandemic itself is over, when we're on top of the virus, that we still are going to be working our way out of an economy that's not going to feel great for some time to come. And one of the measures that we have when we look at the economy was the unemployment rate. Take a look here at this. This is the unemployment rate graph. We hit a high of 10% back in the last recession in 2009, unemployment. That was a huge number for us at the time. You can also see that it's taken us the better part of a decade to work that back down to what we call full employment, which is about 4% or so unemployment. And then with the pandemic and people out of work, this spiked close to 15%. It's come back down now, but this is a very different kind of recession. You can see just in the unemployment numbers than we had last time. It's going to take, I think, quite a while for this to work itself back down again. Hopefully not as long as the last recession, but it's going to impact price sales. Just want to look at one other thing in the economy, and that's this idea of consumer confidence. This is a straightforward survey where they call people randomly every month, and they just ask them questions about how do you feel about the economy? And their responses to those questions that they have give us this consumer confidence index. You can see that it was quite strong before the last recession. And the consumer confidence collapsed as you started having things like repossession of homes and cars and vehicles and bank failures and other things. People were very concerned about the economy. Over the time, as unemployment dropped, consumers' confidence in the economy grew. And in fact, it grew to a very strong level in 2018 and 19. But we've had quite a decline again more recently. But ask yourself, does this look as bad as it was back in 2008 and 9? And I would say not at all. But it's a very different kind of thing going on here. This recession in 2008 and 9 had a lot more to do with asset values declining. And the asset values declining, like home values and things, impacted people more at the high end of the wealth spectrum. So you had people here who lost wealth, but they still had money to spend on food, and they did. We still were eating in restaurants. We didn't have a collapse in restaurants. If you look at this particular area, the recession that we're in right now, this is not a collapse in wealth. This is not asset values falling apart. These are people out of work, people who are food insecure now. That's a very different kind of recession, and I think it has different implications for the kind of things and food products that they're going to buy. And that's why, I say here, it's a different kind of recession. It's about job loss this time around. If people remain out of work and we don't have those additional unemployment benefits, or we don't have the PPP that provided people the ability to remain employed for a period of time, even though the job they're working in may not be functioning at a full level, it's going to be tough. And I'm not sure we've seen all of the impacts for total domestic demand on dairy products yet. This is a consumption-based economy that we have. If you look at the gross domestic product of different countries, this chart is showing you how much of it is contributed by consumption. And, there are different ways that we can think about how do we spend our money. You can spend money on things like capital items. So are we investing in roads and bridges and factories, and are we making things, or are we just buying things, like that fourth color television that's going up on the wall, or 3 vehicles, or, things that are basically being consumed. And that includes restaurant food and that type of thing. Well, it's not right or wrong what kind of economy you have, but the U.S. has had about 71% of its economy based on consumption, whereas countries at the other end of the spectrum, like China, only have 34%. A lot of the rest of what China's been doing has been investing in infrastructure and things that maybe give you more longer-term gains. When consumption can't be maintained like we're having in our current recession, then it has a lot to do with what kind of gross domestic product you're able to sustain. So I think our economy may have a long-term hit. And this impacts things like export opportunities. This is a graph of U.S. all milk price in orange, and that's shown on the right-hand axis. And this is a rolling average of our exports in the blue line, shown as a percent of milk production on the left. And I want to draw your attention, though, to these downturns that we've had when we've had something that's caused exports to fall off, and that's whether you're in a recession like we were here in 2008 and 9. This was a worldwide recession, and export opportunities fell. Those dairy products stayed at home. That had a tremendous plunge in milk prices as a result. We had to absorb that in our domestic markets. Those prices didn't really rebound until our exports came back. Our exports are really taking up this marginal slack in our milk production. When they leveled off again, we saw a decline in price. When they increased, we saw a great rise in price. And our last 5 years of relatively low milk prices here, I think, is arguably due to the fact that we are having trouble exporting as much dairy product as we would like. So exports are really quite important to us. Here's one concern that I have. These are butter stocks. So if you can't export product, or if you don't have enough commercial disappearance for product that's storable can get made and put into our inventories. And you'll notice that there's a seasonal pattern to butter. Generally peaks in May and June. That's during our flush season of the year. We make more butter, and our demand tends to be relatively lower during this period of time. Our big demand for butter happens out here in November, December, and January, when we've got Thanksgiving, Christmas, New Year's, and even on into Super Bowl. But look what's happening here in butter in the red line. The stocks are building pretty strongly. And I'm concerned that this tells me that our butter prices have got to fall yet so we can start to move this butter. Remember, domestic sales of butter, I told you early, are up. They're moving quite well, but we may need to think about can we move butter overseas? Well, what's happening here? I need to go back. Okay. So here's butter prices. Notice during this period of time in the red line, these are US butter prices. The green line is Oceania butter prices, and the blue line is European Union prices. During this period of time, our butter prices were much higher than these other sources of butter out here. And that has had an impact on the US too. The number one brand name of butter in this country is what? It's Land O'Lakes, right? We know that. That's domestic source, domestic use butter. Does anybody know what the number two brand name butter in this country is? It's butter from Ireland. And that butter is an import. And when we have a price difference like this, there's a real opportunity for butter sales to come in from the US. Our butter prices have fallen quite a bit and are in better alignment. And in point of fact, right now, the US butter price is below European prices. So our imports have essentially stopped. This is showing you butter imports, and the green line is showing you butter imports from Ireland. They got very big, but when those prices converged, that simply collapsed. We've still got imports of butter, but nowhere near what we had back in the early part of 2019. Cheese prices have been doing something different. Our cheese has been competitive in many of these years, but you can see what happened during this last COVID time period. Right here is pre-COVID, and we were selling product during this time period. Early in this time period, we had high cheese prices relative to the rest of the world. $1.80 has been kind of the mid-price range for cheese to be exported, and we've had prices that have been as high as $3 a pound. At that kind of price, we're not going to export cheese. But the good news is that we've got strong domestic markets for that product. And, you know, we'd like to sell some cheese overseas, and we may need to develop that further, but we don't need to that quite as much as we do powder and perhaps even butter. I want to go back to our milk production change. Normal for us in a normal year to be in the 1 to 2% increase. That seems to accommodate not only our domestic increases in domestic demand, but also provides us opportunity usually for a little bit more export sales. Here's what happened in April when we had our base excise plans. We went from about 2.7% increase in 1 month down to a negative 0.5 increase in milk production. So that's a pretty big drop. And this was our own supply controls really taking charge. Since that time, we're back up here, I would say, in officially larger than average increases. And this is where I have to question whether or not we can sustain this kind of increase going forward. We still have a precarious demand market, in my opinion. Now, what's happened? Well, cow numbers came down in 2018. They were fairly level through 2019. They began to grow early in the year with some optimism for prices, and then came the pandemic. Part of the way we achieved those base excess plans was by getting rid of animals. But since prices have improved, the animal numbers are starting to grow once again. Milk per cow. You can really see what happened here. We had relatively strong increases this year in milk per cow. And with the base excess plans, we took quite a dip in that and actually were below year earlier levels. But even that's come back. So farms were trying to meet these reductions in supply, both by culling animals, maybe drying off early, but also through feeding. And it turns out that some of those strategies were very different than others. It's harder to bring back milk production per cow until you get to a next lactation if you've brought a mid-lactation cow down in their milk production. So some farms are struggling to try to get the milk production up where they want it to be until the cows are calving again. But many of the farms that used other strategies are back in full milk production. This is showing you just where milk production is increasing or holding steady or declining in the US. This is for the first 3 quarters of 2020 versus the same 3 quarters in 2019. These Central Plains kind of states out here, from Texas all the way up to South Dakota, and even Wyoming, Colorado, all have had big, strong increases. And many of these are pretty big milk producing states. Michigan continues strong. Indiana has been coming on, as well as Ohio. We've been down just a little bit, or our neighbors kind of, mid-term growth. So the strength in milk production is happening mostly west of the Mississippi. But we have to not only think about what we're doing here in the US, where that's the red line, but what about other major exporters? This includes EU as well as New Zealand and Australia and Argentina. You'll see here that everybody declined in milk production, or all the major exporters did, in April and May. But since that time period, we've all been responding and rebounding. And all the major exporters are up above 2% increases in milk production. So there's going to be a lot of milk on world markets trying to find a home. We still got price optimism, though. I mean, look at this. This is showing you the November contract for Class 3 in red and Class 4 in green. Class 3 futures have been just climbing. The last day or two, we've had a decline in these quotes, but for the most part, we've come from $17 price opinions up north of $21. So there's been a lot of price optimism. Here are the forecast factors. We've got optimism about grocery store sales and the positive attributes of this returning to home cooking. When restaurants reopen, we've seen demand for product again in those pipelines. That kind of becomes almost new sales to us now that we've been cooking at home for a longer period of time. As we get back to work in some new version of normal, that's causing optimism, I think, in marketplaces, and we've had export opportunities. Powder prices are just clearing the market at whatever is required to get them out of the country, but we have export opportunities for butter now, I think, at contemporary prices, and maybe cheese a little bit later on. But a lot of this is really going to depend on how the COVID-19 vaccine, better testing and contact tracing evolves. There are real concerns, though, about U.S. and worldwide recessions out here. And I showed you early on that we're kind of involved in this round 3 of COVID, and we want to know when we're going to have an effective vaccine that's broadly administered. Until then, we won't be able to declare this pandemic over. I also think that election outcomes are going to matter. We see polls nightly, but I still think that it's probably too close to really know what the outcome of the election is going to be. And I think we could have very different paths or tracks based on what happens during the election. But to my way of thinking, and until we get COVID under control, regardless of who's in the White House, we are not going to be able to move well past where we're at right now. So here's my price forecast, and I couldn't emphasize more strongly that this comes with a bucket full of salt, not a grain. And the reason I say that is we just don't have a handbook written for a pandemic. Honestly, there's a lot of this that's just based on the optimism we see in futures markets. And I will tell you that if anything, I think this is more optimistic than we might actually see. The blue line is in the dashed color are class 3 prices. The red line are class 4 prices, and the green line are the U.S. all milk prices. So projecting, that we'll be in this $17, $18 range. But, that I think is at the higher end of what we might be able to expect. There's more downside potential in my forecast than there is upside. Did you manage your risk? This was supposed to be a price recovery year. In 2019, that's what we were thinking. We've had a quarter's worth of good payments out there. If you had bought programs like Dairy RP in the fourth quarter of 2019 and put a floor under your prices, you've received substantial payments this year. If you signed up last year for the $9.50 coverage, because my gosh, that's cheap, 15 cents for the tier 1 protection, you should just do that. I'm going to go so far as to say this is coverage you can't afford to not have in place. And, we've received about $6.20 from the CFAP payments, actually over all the milk for this year. It's not $6.20. It averages over all milk something like $2.45. But that's still substantial payments. And if you got any 2 out of 3 of these things, you're largely held harmless. But it's all about cash flow. You got to keep the communication open with your banker. Let me just give you a couple of things that are projections or forecasts. This is the dairy margin coverage forecast graph. The dashed line is showing you the forecast for the year ahead. We're now at a point where we're expecting the first half to 2/3 of 2021 could have payments at the $9.50 level. Clearly markets are volatile and they're going to change, but even with this, we're anticipating payments. And when I said better than we thought, The blue bars here are showing you where the U.S. all milk price has been in the past. If we had had the DMC program in place, the red bars are showing you what the net would have been at the 9.50 level, and minus the 15 cents that it would have cost you there. So this is not tier 2, it's just tier 1. But still, that would have contributed quite a bit in years like 2018 and even last year. And this year, about 55 cents on net, almost 70 cents is what we are expecting will be the total payments this year. And this is the CFAP direct payments. So if you take a look at the total income, I really shouldn't be thought of as a net milk price, but more like milk income, we're above $21 this year. And we haven't seen anything like that, until you go back into, 2011, 12, 13, 14. This almost looks like recovery in terms of milk income per hundredweight. It's better than we thought. We won't be able to count on CFAP payments next year, but the DMC will be there, and so will dairy RP and other things. The improvement in this has also shown that we're still losing dairy farms in Wisconsin, but at a slowing pace. This blue line is the attrition rate in dairy farms in Wisconsin. It hit this high of 10%, but right now we're back just north of 6%. Hopefully we'll get down to a loss that looks tolerable and just reflects people that are ready to exit the industry, not those that are being pushed from the industry. But I did say I would mention PPDs. Whoops, so I will try to do that quickly on here. This is a forecast of prices for class 3 and 4 over here. Anything that's in italics at least is forecast. And the forecast prices are showing you that we are still expecting some negative PPDs. And that's going to be true here, picking up in October again, some negative PPDs in November and December, and even January. They really kind of run out right now in February. Those negative PPDs are coming because of the big spread we have between class 3 prices and class 4. So we pay out on the value of components in the class 3, and when we do that, sometimes we pay out more in components than is available in the total pool, and that gives us a negative PPD. What can happen with negative PPDs, though, is that it provides an incentive for cheese plants to depool their milk rather than contribute to the pool and share that with other plants. They would depool milk, and depending on the degree of depooling, those PPDs could become very negative. This is showing you the estimated PPD over here if nobody depools. But as long as it's negative, class 3 plants have an incentive. Rather than contribute $1 to the pool, they would depool their milk. If we had all of the cheese plants depool, the PPD could be as negative as $6. Typically, we're seeing about half of the plants depooling, and the PPD could be in that negative $3 range for October milk, maybe in the negative $2 range here in November, and maybe $1 range in December. So PPDs being negative are still a thing, and we're going to see more of that.